AI stocks have been the best return on investment that investors could have gotten involved with a couple of years ago. But which stocks are the best stocks to own for the next 3 years and which ones are the worst? That's what I'm going to cover in this video. There's no arguing some of these stocks have just flourished and they've had generational returns. Nvidia up more than 1,000% as an example. Well, I'll research each company that I've got listed and take a look at what I think is going to happen in the future with regards to their valuation and their stock price. Now, the AI market isn't going to be this great forever, and it's going to evolve. AI itself is really being met with very low return on investment from the companies that have invested. An example of that is Meta. Meta came out with their earnings and they did show that they spent a lot of money on AI, but didn't have a lot to show for it. Now, if a company like Meta, with all the resources, knowledge, and intelligence that they have, if Meta cannot find a way to create a business, show real revenues, real profits, and real value, then the typical corporation really doesn't stand a chance. How would a typical organization get money or value from AI? It's probably going to be a case of corporations are going to pause their spend on AI, and we will have to wait maybe 5 years to really see what types of use cases are going to be the best ones for AI. And we'll actually know which businesses are going to be in for the long haul and be good businesses to own over the course of time. So let's take a look at these stocks and I'll give you my opinion on where these stocks are valued, what their risks are, and if they're a good stock to own or if they're a terrible stock to own. You're watching a video that I created over 30 days ago. If you'd like to watch videos on the day that I release them, consider being a paid member. You can get more details on the 4 levels of membership on my YouTube channel homepage. Nvidia has been a great stock to own for the last 3 years. It has gone up like a rocket ship headed toward the moon. And the stock recently has had a pullback, but it has become the most valuable company on the stock market at nearly $4.5 trillion. You have to pay up. The PE is 52, but the forward P doesn't look too bad at 31. And when we look at their earnings and revenue growth, it has been really explosive, growing just fundamentally, doubling in value. That is really incredible. Analysts believe that this stock could go higher. Some of them have a price target at 350, and some of them believe that it's priced too high with a price target at 100. On average, they believe the stock is discounted by 20%, and they're taking most of those valuations based on earnings per share. When we look at the growth isn't going to last forever. And you see that in the fiscal year 2029, which is really 2028, they're only going to grow by 4.5%. So we'll see if the market really keeps the valuation really high, considering that the growth rate is really going to slow down. It makes sense. NVIDIA sells GPUs, semiconductors, and these semiconductors last for a while. I don't know, maybe 5 years, 7 years. And once they sell into the data centers, they won't have to buy for a while. So at a certain point, you would expect that the demand for these chips is going to slow down. The PE ratio is supposed to come down as the company gets larger and larger. I've completed a valuation on Nvidia, and my calculations arrive at the stock being 21% too high. I actually believe that each share is worth $146 per share when I value it based on the free cash flows I expect from Nvidia as well as its earnings per share. So overall, the stock is priced 21% too high. Now, this stock has had periods of awesome momentum. It's also had some pullbacks. We're currently in a pullback. And really, the art of investing is if you believe that Nvidia is going to climb higher, maybe after this pullback, then the world's your oyster. Go for it. But if you're more like me, where you're a little more conservative and are considering the fact that at some point Nvidia is going to slow down, the spend on AI chips is going to slow down, I'm going to pass. Nvidia would be a sell in my book. Broadcom is up more than 800% over the last 5 years. Incredible rise. This stock as well is currently in a pullback, but it's become a $1.59 trillion market cap company. Not too long ago, a couple of years ago, it was $350 billion in market cap. I owned Broadcom for some time and sold it in 2024. The P ratio is quite high, 85 for this year, and it stays a little high at 40 going into 2026. Analysts believe that it's close to fair price at a 5.3% discount. The company has been growing revenues, not as incredibly as Nvidia, but the growth has been good. Not incredible, but good. When we look at what analysts believe is going to happen, 28 analysts cover Broadcom. We have an analyst with a price target of 450 and then an analyst at 210. So on average, they think the stock is close to fair price. When we look at their revenue, it's supposed to continue to grow. And that is very good growth. Going into 2028, a growth rate of 23%. And its P ratio should come down to the 20s in 2027 and 2028. The question is on Broadcom, will the competition from the other semiconductor companies that can provide similar compute capacity really weigh down their revenues? If there's more competition, it's at least going to affect the price that Broadcom is going to charge. If that's the case, that's a headwind for Broadcom. I've completed a valuation on Broadcom and I arrive at a 24% premium. I believe each share is worth $254 per share, but each share is being sold for $335 per share. The cash flows don't measure up to the current stock price. The earnings per share do. I'm actually in agreement with the analysts that are out there. But overall, I don't believe Broadcom has the competitive advantage that Nvidia has. I don't believe they can defend their marketplace as well as Nvidia can, because Nvidia is the only one with the really high performance GPUs, where Broadcom provides semiconductors where there are more substitutes for its product in the market. Microsoft has put themselves at the center of the AI ecosystem by acquiring a portion of ownership in OpenAI, as well as operating one of the biggest hyperscalers, one of the biggest cloud infrastructure enterprises in the market. Both of those enable it to really grow its value, and it's currently a $3.7 trillion market cap company. Its P ratios are 35 on the current year and 30 for the next year. Analysts believe there is a discount available on Microsoft. Its revenues have been really impressive. It's a very big company and it continues to grow. Even in the quarterly, the growth was even better than the annual rate. Those things really bode well for the company. Analysts, 31 of them, cover the stock and they believe there's a 25% discount. The highest price target is $700 and the lowest at $550, showing that there's very little downside in Microsoft stock. When we look at the forecast, they're going to continue to grow at the same rate, and that's a big, giant number. They will be a $500 billion revenue company in 2029, and their PE ratio will drop to 18.5 unless the stock price rises. I believe the stock price will rise over time. I've completed my valuation on Microsoft and believe that the stock is fairly priced. It's just priced slightly above its intrinsic value. Each share is worth $485 a share, and it's currently being sold at $504. Its cash flows are excellent. Its earnings per share is also very good. Overall, this is one of the least risky companies I'm going to cover, and their credit rating is up there with the best companies in the market. So overall, this is a lower risk way of investing in the AI ecosystem, and Microsoft, in my book, would be a buy. Alphabet Google is at the center of the AI ecosystem. They have Gemini, which is a consumer or business application that people can integrate into their work stream or their personal lives to get really good information from Gemini using their AI capabilities. They also had cloud infrastructure, helping businesses build AI platforms, applications, agentic AI. Last, they have a real life robo-taxi business in Waymo, which is the biggest operating business in the United States that does true physical AI in the form of robo-taxi. This stock has done well over the last 5 years, and it's become a $3.46 trillion market cap company. P ratio looks pretty decent at 27.5, and the forward P is 26. Not too long ago, this stock was really sold off and was a huge opportunity that I took. I bought shares. Looking at the growth, although this is a very large company, they are still growing at 16%. At some point, this will be a $500 billion company, and it is incredible to see them grow by those percentages, even though they're so large. Analysts have price targets up to 350 and the lowest being 190. Overall, they believe the stock is close to fair price, just with a 5% discount. The growth of the company is going to persist. growing in the teens, 12% in 26, 12% in 27, and a little over 12% in 28. And they will be over $500 billion in revenue. Their profits and cash flows will go up. And this doesn't really include the potential growth of AI in the form of their Gemini business as well as their robotaxi business and Waymo. So things really look good for Google. I completed my valuation on Alphabet Google and I come up with a 33% discount available on this stock. We've had a recent pullback bringing down the stock price. I believe each share is worth $416 per share, but you can buy shares for $278. The difference mainly is in the cash flows that I expect from the business. They're really going to have a very good cash forecast. And I believe if I look at the net present value of those cash flows, it's 30%, 37% more valuable than its current stock price. So this is a buy all day long for me. I will be accumulating more shares of Google Alphabet. Amazon is strategically positioned in the AI ecosystem by owning a portion of Anthropic. Also, they have the biggest cloud infrastructure business in the market. Therefore, as companies need infrastructure to build out AI, operate AI, Amazon will make money. Amazon also has a robo-taxi business in the brand Zoox, which is behind Waymo, but is operating in a few cities already. So Amazon has a very good grasp on the current most popular businesses like e-commerce, video streaming, advertising on their properties, and now AI, which really has a grasp on the future. Amazon is the largest revenue company of any publicly traded company out there, even bigger than Walmart. And incredibly, in 2028, they will come close to $1 trillion in revenue. And they continue to grow their revenues by almost 11%. That is incredible. The earnings per share is also going to expand, and their PE ratio will drop down to 20 in 2028. But I think the stock's going to rise over time. Amazon has a 27% discount on their stock, according to my analysis. I think each share is worth $328 per share, but each share is being sold for $239. That 27% discount is really biggest part of it is the value of their free cash flows. This company has become so big and powerful and they generate really good cash. So this is definitely a buy stock for me. I'm accumulating Amazon and feel it's going to be a big beneficiary of the whole AI build out. CoreWeave is a cloud infrastructure company attracting businesses that want to build out AI in their data centers. And the stock has done well since it IPO'd overall, but it's had a pretty good correction more recently. This is a smaller cap compared to the other three big hyperscalers at $40.5 billion of market cap. Money, the company loses money, and therefore we don't have a PE ratio for the company. Analysts believe it's highly discounted. When we look at this business, we have 23 analysts covering it, and the price targets are all over the place with a high price target at $200 per share, the low price target at 32. The forecast for the business looks pretty promising for the next couple of years, but this market could be disrupted. If you have a slowdown in AI, CoreWeave is going to see their revenues really shrink. They're not going to make money until 2027. And between now and then, there'll be heavy losses, as well as a lot of capital needs to go into their data centers, making them a risky stock. CoreWeave is a riskier stock to own if one wants to own a cloud infrastructure business compared to Amazon, Microsoft, or Google. And they are also priced too high. I believe their stock is priced 29% too high. If I measure their value, I think their stock price is really worth about $55 per share, but they're being priced at 78. The stock has been coming down, but this stock is way too risky for me. I'd rather own the other big hyperscalers that have a diversified business as opposed to CoreWeave. This is a one-trick pony. If the data center goes down, or I should say revenues come down in the data center, CoreWeave has no other business to lean on. So for me, CoreWeave is a sell. Data centers are going to need a lot of electricity in order to power all the AI infrastructure. And one of the companies that will provide that power is General Electric in the form of their turbines that burn natural gas and generate powers on site at these data centers. That said, General Electric stocks really flourished over the last couple of years, and the stock has become a $321 billion market cap company with its P ratio at 40 for the current year, moving up to 45 for the next year. Analysts think it's fairly priced with a small premium. Now, General Electric is growing its revenues mid-teens, but its margins are quite low, which is one of the concerns I have on the stock. 9 analysts cover the stock, and the high price target is 366, the low being 222. So some analysts are concerned that it's priced too high. It is going to continue to grow in 26, almost 12%, then 10%, then 7%. But its profits are not very high, and its cash flow generation isn't very high as well. So General Electric is not as lucrative as other companies that are in the AI space. The value of General Electric free cash flows and profits don't measure up to the stock price. I actually think the stock is priced 32% too high compared to its real value of $208 per share versus the $305 per share it's selling at. And the principal reason is General Electric doesn't have high margins. It actually has pretty low margins compared to other businesses. Yet the market really believes that it's really going to turn into a lot of value. But I measure value in the form of cash and profit. And that just doesn't exist with General Electric high enough. General Electric is a sell in my book. Since AI will need a lot of power at the data center sites, the idea to create nuclear reactors to generate that power has become alive. And Oklo is one of the companies that has an idea of creating these small units that will provide the power to these data centers. It's an idea, but at this point, that's all it is. This company doesn't generate any revenues. Incredibly, it's become an almost $16 billion company. Its stock has really risen more than 900%. And this company, when we look at a forecast, it's not expected that they will generate any revenue for a while. 2026, they'll generate only $283,000. In 27, $3 million. Those are tiny numbers compared to that valuation. So this business may succeed in putting out these units that'll create power. But at this point, we don't even know if they're going to make money on those units or if they're just going to be burning cash year after year for the next 5 to 10 years. This is absolutely a very high risk stock to invest in. Vistra is a utility company, and they're positioned to sell a lot of power to data centers. The stock's flourished up over 800%. The market cap for the business is 58 billion, but the PE ratio is 62 in the current year, dropping to 18. Analysts think there is a discount available on this stock. What is incredible is the lack of growth compared to that stock appreciation. The growth has been okay and will continue to be okay for the next year and a half, but then it's going to slow down and actually contract in 3 years. So, how is a business that's growing modestly and then going to a no growth mode valued so much? Utilities have low margins, and utilities usually drive very poor free cash flow if any cash is left after the business has to put back capital into the operations of creating power. So this business here, I think, is overly priced and overly risky. I completed a valuation on Vistra and believe that the stock is priced 43% too high. Each share is worth $97 a share, but they're being sold for 172. The market's really taken this stock really high, but the company just will not drive the cash flows that will add up to that type of stock price, nor the profits. So this is a sell stock for me all day long. Palantir has been a really successful company creating software and technologies within the AI space. The stock has gone up over 1,000% in the last 5 years, and it's become a $410 billion market cap company. It does have a very high price to earnings ratio of 399 and a forward P of 187, which is really high. Analysts believe it is slightly overpriced. When we look at the overall forecast for Palantir, their growth will continue. So they will become over an $11 billion revenue company in 2028, and their PE ratio will come down to 104. That's still very, very expensive. Overall, I think Palantir is a terrific big business, but the stock price has just gotten way too high. When I value Palantir, I come up with a stock price that is 63% too high. Each share in my book is worth $63 per share, but it's being sold for 171. The cash flows are quite low because the business is quite small at this point compared to its market cap, and I can only get up to about 40% of the value of corresponding to its stock price, and the profits as well. I can't get to the current stock price. So overall, this is a sell stock for me. I would not own Palantir, but understand that a lot of people really like this stock and have done great with it. A company that's invested a lot into AI but has really nothing to show for it is Salesforce. Salesforce has built an agentic AI business, agentic AI to give businesses the ability to take some human driven tasks, maybe some mundane tasks, and move them to an AI platform where AI agents would complete the work. I think this is going to be something real someday. But at this point, the market's just not recognizing Salesforce as a value driver within the AI ecosystem. The stock over the last 5 years is down 3%. Its market cap is 229 billion. It has a relatively low PE ratio, especially on the forward year. It's 20 looking at 2026. Analysts believe it's highly discounted. And when we look at their forecast, this business continues to grow. It's very profitable and generates cash flow, and it'll continue to grow, becoming over a $54 billion revenue company in 2029. The profits are also going to expand. Its P ratio is going to drop to 14. So Salesforce is highly discounted. When will the market begin to appreciate a software company that has invested so much in AI? That's the question with Salesforce. I've completed my analysis on Salesforce and believe that the stock is discounted by 47% if I weigh the value of their cash flows, the value of their profits, and compare it to its current stock price. So overall, Salesforce is a hidden gem. And the only question is, when will the market begin to rally the stock? And at that point, I would be a huge buyer of Salesforce. Tempus AI is providing an AI experience within healthcare, allowing people to use the platform to diagnose issues, research, and get healthcare information, if not services. Tempus AI IPO'd in the middle of 2024, and since then, the stock is up 83%. It's become a $12 billion market cap business with revenues of 1.1 billion. The company is growing its revenues quite nicely in the current year and next year. It's a strong buy with a 16% discount, according to analysts. 12 analysts cover it, and they believe the stock is discounted by 16%. When we look at their forecast, their revenue is going to grow nicely in 26 at 24%, then 23% in 2027. They'll be about a $2 billion company in 2027 and generate a profit in that year as well. So this is an interesting stock, but very high risk because the adoption rate, is it going to be approved by the FDA? What kind of liability would hospitals have or organizations have over the AI recommendations and information that's being delivered? So overall, this is an interesting idea, but not an investment I would make today. UiPath IPO'd in 2021, and this company was ahead of the curve. They actually provide a platform to automate a lot of human tasks with AI and machine learning. It's an idea that really fits the time, but the stock's really sold off. It's sold off by 75%. When we look at what analysts think of UiPath, there's not a lot of excitement. The stock is fairly priced, and as I showed, the stock really gave up a lot of its price over the last couple of years. What's also interesting is, even though AI is all the craze, here's an AI platform company. This is all they do, yet they're not growing very fast. Businesses are not automating with their AI platform, and this company is growing 12% in the current year, close to 9% next year, and then 7.7% the year after. And they are relatively a small business compared to a Salesforce or another company that's much, much larger. So this business is a good business. They're making money, but I don't know when the market's going to start to buy it. That's one of the things that is interesting about AI. AI for the data center, the market's going crazy over semiconductor, buying up semiconductor stocks, buying up energy producing stocks. But when it comes to the actual usage of AI put into businesses to drive return on investment, in this case with UiPath, the market doesn't recognize that as an investment worth having. I've completed evaluation on UiPath and I come up with a 6% discount on this stock. The stock does drive profits and cash flow, and it has a very good balance sheet. So overall, that small discount would enable me to watch the stock. If it were to sell off, maybe it's a buy at that point, or if its fundamentals improve, it might really begin to drive more attention and increase its valuation to become a buy stock down the road. What are the best and the worst stocks that I can invest in within the whole AI ecosystem? Let me start from the best to the worst. The best three stocks that I could invest in are Google, Amazon, and Microsoft. These are diversified businesses that have very good cash flows, are very well invested in AI, and have the ability to be there for the next 10 years and reap the rewards of AI. So that's where my capital is going to go. Some notable names that I think are worth following are Salesforce, UiPath, and Tempus. These companies are delivering value at the end user layer to the corporation that invests in AI in the form of agentic AI, machine learning, and so forth. Nvidia, Palantir, and General Electric are terrific businesses, but they're just priced too high. Chances are investors are going to lose money there just because it's about how you buy a stock and not necessarily the quality of the business. So, although I think their businesses are great, their stock prices are much too high. Now, for the worst. The very worst stock that I could buy is Oklo. Unproven business, unproven fundamentals. They may not even get to a product, which would be an absolute complete loss for investors. My capital will not go to Oklo. Vistra is priced much too high as a utility and is probably going to chew up capital trying to renovate its power plants, and that will probably result in losses for investors. Broadcom is priced much too high, and I think they're going to start seeing much more competition from an array of semiconductor companies going after the data center. And CoreWeave. CoreWeave does not have the same luxury that Google, Amazon, and Microsoft have in having diversified businesses that are generating a lot of cash. They actually are just in one business. If the data center has a pullback, if we have a recession within the data center, CoreWeave is going to have a lot of trouble, and they're carrying a lot of debt. So that's my review of the best and the worst stocks that are in the AI ecosystem. Thank you for watching the video. I hope you found it interesting. Would you like more access to content like this? Consider being a paid member. You get more real-time access to videos when they're published. You also get access to a Discord and many other value add benefits for investors, like access to the tools that I use when I analyze stocks. Take a look at the 4 levels that are available on the homepage of my YouTube channel. Thank you.